In 2025, big tech will pour roughly $400 billion into AI infrastructure, fueling valuations that demand perfection as the stock market's Shiller CAPE spikes to its third highest reading in 154 years. This is more than just déjà vu of the dot-com era. It is a new bubble where companies spend $9 on AI for every $1 in revenue, and history says these heights rarely end well. But what makes this surge different, and what comes next when patience is all that stands between investors and another drawn-out crash? A single number now stands out on Wall Street's dashboard: the Shiller CAPE, the cyclically adjusted price-to-earnings ratio. In 2025, that figure hovers around 40. To put this in perspective, the long-term average is about 17. Only twice before, at the peaks in 1929 and 2000, has this ratio crossed into such rarefied territory. Each time, the years that followed brought disappointment for investors who bought in at those heights. The CAPE isn't just another market statistic. It smooths out earnings over a decade, stripping away temporary booms and busts. When this ratio climbs to these kinds of levels, history shows that future returns tend to shrink. Academic research, from Robert Shiller's own work to independent studies by Vanguard and Credit Suisse, has tracked what happens after CAPE readings above 35. The results are remarkably consistent. Real stock market returns over the next 10 years have averaged less than 2% a year, and sometimes dipped below zero. In the aftermath of 1929, the decade that followed delivered negative real returns. Investors who bought at the dot-com peak in 2000 faced a similar fate, with the S&P 500 taking more than a decade to recover after inflation. The current reading doesn't just break records, it sets expectations at a level that leaves little room for error. A CAPE of 40 means investors are paying 40 times the average of the past 10 years' earnings for each dollar of the market. That's a price tag that assumes not just growth, but near perfection. The higher the ratio, the more it reflects optimism about the future, and the less margin there is if reality falls short. Yet, the CAPE's story is more than just a warning from the past. It's a snapshot of today's collective belief in the power of AI, the promise of new business models, and the conviction that this time might be different. But the numbers don't lie. With the ratio this elevated, the odds of repeating the market's best decades are slim. The question now isn't whether the market is expensive, it's how much future growth is already baked into today's prices, and what happens if that growth stumbles. In markets, there's a phrase that comes up: when expectations leave no room for error, priced for perfection. It describes moments when investors are so confident in future growth that they are willing to pay almost any price today, assuming nothing will go wrong. In 2025, with the Shiller CAPE at 40, that phrase is not just jargon, it is a reality. At these levels, the market is effectively betting that the biggest companies will keep delivering flawless results year after year, and that the economy will avoid any surprises. The math behind it is simple but unforgiving. Historically, whenever the CAPE has pushed above 35, the next decade has brought real annual returns under 2%. Sometimes, as in the years after 1929 and 2000, the returns were negative. For every $1 invested at those peaks, it took patience and a long horizon just to break even. This is where the idea of a margin of safety matters. When prices reflect perfect outcomes, there is little cushion if reality comes up short. Even small disappointments, a missed earnings report, a slowdown in AI adoption, or a policy change can trigger sharp corrections. The higher the starting valuation, the more future profits are already spoken for, leaving little upside and plenty of risk. It is not just about missing out on gains, it is about the very real possibility of losing ground over years or even decades if history repeats. Investors sometimes convince themselves that extraordinary times justify extraordinary prices. But the evidence from more than a century of market cycles is clear. Buying when everything looks flawless has rarely ended well. The most reliable way to protect capital is not to chase the crowd, but to insist on a buffer, a price that allows for mistakes, setbacks, and the unexpected. This is not pessimism, it is discipline. And it is the difference between surviving a market storm and being swept away by it. The test of any boom is not how high prices climb, but how they hold up when reality intrudes. To understand what happens when perfection is priced in, it helps to look back at the stories of other eras, times when markets soared on hope, only to collide with the limits of growth and the weight of unmet expectations. In November 1998, the Globe.com went public. The founders, both in their 20s, watched as their company's stock surged 606% in a single trading day. They had started as a college dorm project, and in less than a year found themselves at the center of a frenzy. The initial public offering opened at $9 and closed at $63.50, even though the company had no profits and almost no revenue. On the floor of the exchange, brokers cheered as the ticker climbed. By the closing bell, the world had a new record for a first-day pop. For a moment, it seemed like there was no limit to how high prices could go. The Globe.com was not alone. Across Wall Street, companies with barely a business plan were raising millions overnight. Most had never turned a profit. Some had never shipped a product. Yet investors lined up, convinced the internet would rewrite every rule of business. The NASDAQ index, packed with tech stocks, soared from under 1,500 at the start of 1998 to over 5,000 by March 2000. In just 2 years, trillions of dollars in market value appeared on paper. Magazine covers declared a new era. Venture capitalists chased the next big thing, often with little more than a website and a pitch deck. The Globe.com's founders became instant celebrities. Their story was told and retold as proof that the old rules no longer applied. In interviews, they described the initial public offering as surreal, watching their net worth jump by hundreds of millions of dollars in hours. But behind the scenes, even they worried about how disconnected the market had become from reality. The company's revenue for the year before the offering was less than $1 million. Its losses were 10 times that. Yet, for a brief window, none of that seemed to matter. At the market's peak in March 2000, the NASDAQ closed above 5,048. The index had more than tripled in just over a year. Stories circulated of day traders quitting their jobs, of office workers checking stock quotes between meetings, of new millionaires being minted by the hour. The pace was relentless. Each week brought new highs, new initial public offerings, and new fortunes. The logic was simple: buy now, sell higher. Risk was an afterthought. The only thing that seemed to matter was speed. But euphoria has a way of masking risk. The faster prices rose, the more invincible investors felt. Companies like the Globe.com became symbols of an age when expectations soared far ahead of reality. The warning signs were easy to ignore. For those caught up in the moment, the future looked limitless until it did not. When the dot-com bubble burst, the pain didn't stop with falling stock prices. From March 2000 to October 2002, the NASDAQ lost 78% of its value, wiping out trillions in market capitalization. But the real hangover lasted much longer, and its scars ran deeper than any single index chart could show. Telecom companies, swept up by dreams of an internet-powered future, had laid enough fiber optic cable to circle the globe many times over. Yet, when the dust settled, between 85 and 95% of that fiber sat unused. Dark fiber running beneath cities and across continents, waiting for demand that never arrived. Corning, once the world's leading fiber supplier, saw its stock price collapse from nearly $100 to just $1 in a matter of years. Warehouses filled with unsold cable, and entire business lines disappeared overnight. For investors and employees alike, the promise of endless growth gave way to layoffs, bankruptcies, and years of lost opportunity. The story was no different for the vendors who supplied the boom. Cisco Systems, the undisputed king of networking hardware at the time, reached a market capitalization of $555 billion in March 2000. Its price-to-sales ratio soared above 35, and its price-to-earnings ratio topped 200. But as orders dried up and customers defaulted, Cisco's stock fell by 86%. Even a quarter-century later, it has yet to reclaim that peak. The lesson was clear. Even the most innovative companies are not immune to the consequences of overbuilding and overconfidence. These long, slow recoveries weren't limited to the internet era. In the late 1920s, RCA, then the face of the radio revolution, shot from $85 to $549 in just over a year. When the bubble burst, the stock plunged to $18. It did not return to its old highs for another 27 years. Investors who bought at the top faced a lifetime of waiting just to break even. The aftermath of a bubble is rarely a quick correction. Instead, it is often a decade or more of lost ground, with capital tied up in assets that no longer serve their intended purpose. The NASDAQ itself, after peaking in 2000, took nearly 15 years to recover its former high. For anyone who bought in at the wrong time, the opportunity cost was enormous, a generation's worth of savings locked away, earning little or nothing while the world moved on. The pattern repeats. Infrastructure built for a future that arrives more slowly than expected, vendors riding the crest of demand only to see it vanish, and investors learning that recovery can take far longer than the initial climb. The lesson isn't just about how much is lost in a crash, but how long it can take to regain what was lost. It is a reminder that the real cost of a bubble is not measured only in dollars, but in years. In 2025, the world's largest technology companies are pouring capital into artificial intelligence at a pace that dwarfs anything seen before. Combined, Microsoft, Amazon, Google, and Meta are guiding for nearly $400 billion in capital expenditures this year alone, most of it earmarked for AI infrastructure. These spending plans are not guesswork or analyst projections. They come directly from earnings calls and financial disclosures, where each company lays out its intentions in black and white. Microsoft's guidance stands out. Around $120 billion is set aside for 2025, a figure that includes new data centers, high-performance networking, and millions of NVIDIA GPUs. Amazon's commitment is nearly as large, with about $100 billion devoted to expanding Amazon Web Services and building out the hardware needed to serve the next wave of generative AI applications. Google's capital plan runs to roughly $85 billion, much of it aimed at boosting the capacity of its Gemini and Vertex AI platforms. Meta, not to be left behind, is guiding toward $70 to $72 billion, with plans for massive power-hungry data centers and a fleet of over 1 million AI accelerators. These four companies, sometimes called hyperscalers, are responsible for almost the entire surge in global AI infrastructure spending. Their combined outlays are now larger than the annual gross domestic product of entire countries. Industry analysts estimate that globally, AI server spending will reach $82 billion in the second quarter alone, with nearly 90% of that driven by these firms. The United States dominates this race, outspending China by more than 6 times in the AI build-out. Capital is flowing into every corner of the supply chain. Chips from NVIDIA and AMD, land and power contracts for new data centers, and the networking equipment needed to connect it all. The scale of these investments signals a conviction that AI will reshape not just the tech sector, but the broader economy. Company executives speak of a new era, where generative AI becomes an everyday tool for businesses and consumers alike. Yet the numbers are staggering. For every dollar of realized AI revenue, these firms are spending many times more to lay the groundwork. The bulk of this year's $400 billion outlay is going toward assets with uncertain payback periods, hardware that may become obsolete in a few years, and facilities that require constant upgrades to stay competitive. The sheer size of these commitments is unprecedented. In 2025, AI-related capital expenditures are responsible for more than half of United States' gross domestic product growth, according to third-party research. The infrastructure arms race is driving demand for everything from advanced semiconductors to industrial-scale power hookups. Even as some question whether the market for AI services can keep pace, the cash outlays continue, setting new records quarter after quarter. For the first time, capital spending by a handful of companies is shaping not only the technology landscape, but the trajectory of the entire economy. Microsoft's current spending tells a story that is hard to ignore. The company is guiding for about $120 billion in capital expenditures for 2025, with most of that aimed at building out AI infrastructure. Yet its reported AI services revenue is running at just $13 billion annually. That's a ratio of roughly $9 spent for every $1 earned, a gap that raises questions about the timeline for payback and the risks involved if projected demand does not materialize. This mismatch is not unique to Microsoft. Across the largest U.S. technology firms, Microsoft, Amazon, Google, and Meta, the past 2 years have seen about $560 billion poured into AI infrastructure. In that same window, their combined AI revenue is estimated at only $35 billion. The math works out to about $16 of spend for every $1 of realized revenue. These numbers, drawn from company filings and third-party research, reflect an industry-wide bet that future AI demand will catch up fast enough to justify today's outlays. The scale of these investments is visible in the physical world. Physical scale. Meta is constructing a data center designed to draw 2 gigawatts of power and house, around 1.3 million GPUs. The hardware alone represents a capital commitment that would have been unthinkable a few years ago. But the useful life of these assets is short. AI models and the chips that run them can become obsolete in as little as 2 years, forcing companies to refresh their infrastructure before the original investment has fully paid off. To bridge the gap between spending and revenue, some companies are turning to creative financing. Hidden debt. Meta, for example, has arranged about $27 billion in off-balance sheet financing to fund its latest data center projects. These financing structures push obligations into the future, keeping them out of sight for now. But they also introduce new risks. If AI revenues fail to ramp as quickly as planned, the burden of servicing this hidden debt could become a problem. The economics of AI infrastructure are built on the hope that utilization rates will rise, that new applications will drive steady demand, and that each dollar invested today will generate returns tomorrow. But the numbers show a wide gap between spending and realized revenue, and the speed at which hardware becomes outdated adds another layer of uncertainty. As the industry races to build bigger and faster, the question of who ultimately pays for the gap, shareholders, lenders, or customers, remains unresolved. For now, the economics of the AI boom rest on a foundation that is both ambitious and unproven. OpenAI's rise has been fueled by a scale of financial commitment that stands out even in the current era of big spending. Scale. By 2025, the company is valued at roughly $500 billion, remarkable for an outfit with projected annual revenue of only about $13 billion. Yet the real headline is the size and structure of its obligations. Industry analysts estimate that OpenAI has committed to spend as much as $300 billion over 5 years on Oracle's cloud infrastructure, a figure that works out to around $60 billion per year. These numbers are not confirmed in public filings, but they reflect the scale that both companies have publicly hinted at in earnings calls and press briefings. The mechanics of these deals are complex. OpenAI's commitment to Oracle includes minimum usage guarantees and exclusivity clauses, tying both firms together for years to come. At the same time, the lines between vendor and customer have started to blur. NVIDIA, the world's dominant AI chip supplier, is estimated by some analysts to have taken a sizable equity stake in OpenAI, potentially as much as $100 billion in value, though this too is based on outside estimates. Circular. The logic is circular. NVIDIA invests in OpenAI, OpenAI spends those funds buying NVIDIA's chips, and the cycle continues. Each party's growth projections rely on the other's willingness to keep the money moving. These arrangements have echoes of the vendor financing that fueled the telecom boom in the late 1990s, when hardware suppliers lent money to customers who then used it to buy more hardware. Today's version is more sophisticated. involving equity swaps, long-term purchase commitments, and special-purpose vehicles that keep many of the risks off the balance sheet. Yet the underlying exposure remains. If OpenAI's anticipated demand falls short, Oracle is left holding underutilized data centers, while NVIDIA's revenue could take a hit if hardware orders slow. On paper, these commitments paint a picture of unstoppable growth. In practice, they lock each company into a web of obligations that depends on demand materializing exactly as forecast. Staggering. For now, the numbers are staggering. Hundreds of billions of dollars in commitments, supported by a revenue base that is still catching up. Across the financial world, one institution stands apart from the current rush to deploy capital at any cost: Berkshire Hathaway. While others pile on leverage and chase the promise of AI-driven returns, Berkshire sits on a cash reserve that now exceeds $300 billion. This is not a defensive crouch, but a deliberate choice, shaped by decades of experience weathering booms and busts. Warren Buffett and his team have made their position clear in recent letters to shareholders. They describe their growing cash pile not as a sign of fear, but as an exercise in discipline. When markets are flush with optimism and valuations reflect perfection, Berkshire prefers to wait. The company's annual meeting in May 2025 echoed this stance. Buffett pointed to the lessons of history, the years when easy money and soaring expectations led to deep drawdowns. He reminded shareholders that the first rule is simple: don't lose money. The second is just as important: never forget the first. Berkshire's approach stands in stark contrast to the leveraged bets now common among tech giants and their suppliers. While others structure off-balance sheet debt or enter into long-term commitments with uncertain payback, Berkshire's capital sits idle, earning modest returns in short-term securities. This patience is not about timing the market, but about insisting on a margin of safety, a buffer against the unknown. Internal memos later cited by journalists reveal the thinking behind this strategy. Investment managers at Berkshire argue that when the world is gripped by FOMO, the best opportunities often come to those willing to wait. They point to past cycles, when cash on hand allowed them to buy quality businesses at fair prices after the fever broke. Discipline. The contrast could not be sharper. On one side, companies are stretching to meet demand projections that may or may not materialize. On the other, Berkshire waits for the cycle to turn, confident that patience will be rewarded. In times like these, the fortress of cash is not a retreat. It is a position of strength, built for the moment when discipline is once again in short supply. In 2025, the S&P 500 looks less like a broad market and more like a showcase for a handful of giants. The top 10 stocks now account for nearly 39% of the entire index's weight, an unprecedented concentration in modern financial history. Within this small group, the Magnificent Seven have become the main engine of market returns, responsible for about 75% of the S&P 500's gains this year. Decisions made in a few boardrooms ripple through portfolios, retirement accounts, and pension funds across the country. Index committees charged with maintaining a balanced representation of the United States economy find themselves wrestling with a dilemma. The rules say the index should reflect market value, but when so much of that value is tied up in a handful of names, the result is systemic exposure to just a few companies' fortunes. For every dollar flowing into passive funds, nearly 40 cents are now allocated to 10 firms, leaving the other 490 companies to split the remainder. This is not a theoretical issue. When Apple, Microsoft, or NVIDIA move, the entire market moves with them. For smaller companies, even strong earnings or innovation can go unnoticed, drowned out by the gravitational pull of the index heavyweights. The economic impact goes beyond the stock market. In the first half of 2025, AI-related capital expenditures by these mega caps accounted for over half of all U.S. GDP growth. The scale of their investment is so large that it shapes not only the technology landscape, but also the broader economy. Real estate markets respond to data center construction. Utilities scramble to meet soaring power demand. Local governments negotiate tax deals and infrastructure upgrades to attract the next wave of AI build-outs. This concentration creates both power and fragility. The fortunes of millions are now tied to the success of a few firms betting heavily on AI. If those bets pay off, the rewards will be enormous. But if expectations falter, the consequences will be felt far beyond Silicon Valley. The index, once a diversified measure of American enterprise, now leans on a narrow foundation, one that could amplify both gains and losses as the cycle unfolds. In 2025, venture capital is flowing into artificial intelligence at a rate never seen before. This surge is unprecedented. Nearly two-thirds of all United States venture dollars, about 64%, are now aimed squarely at artificial intelligence. More than 1,300 startups have crossed the $100 million valuation mark, and close to 500 of these are labeled as unicorns, each supposedly worth at least $1 billion. Yet beneath the headlines, the numbers tell a different story. Roughly 70% of these artificial intelligence unicorns are unprofitable. Many depend on continued funding rounds rather than sustainable business models. At major pitch events, investors scramble to back any company with artificial intelligence in its name. Some startups have raised over $1 billion in less than 2 days. Leaked investor group chats capture the mood, fear of missing out, herd mentality, and a sense that missing out is a bigger risk than backing a bad bet. A recent study from MIT looked at enterprise artificial intelligence pilots across large companies and found that about 95% failed to produce meaningful business outcomes. That is despite more than $40 billion invested in generative artificial intelligence projects since 2023. In one case, a Fortune 500 company spent millions of dollars on an artificial intelligence pilot that never made it past the trial phase. Internal reviews blamed poor technical fit and resistance from employees. The project champion, a high-profile CTO, was quietly reassigned. Stories like this are not rare. They are becoming the norm. The gap between capital chasing artificial intelligence and real-world adoption is wide. For every breakthrough, there are dozens of pilots that stall or quietly disappear. The pressure to show progress pushes startups to promise more than they can deliver, while venture firms keep the money flowing in hopes of finding the next winner. In this environment, the risk is not just that individual companies will fail. The risk is that the entire ecosystem is being built on assumptions that may not hold up when the excitement fades. The history of tech bubbles shows that when capital outpaces results, the consequences can linger long after the headlines move on. Today, $400 billion chases AI infrastructure, while actual revenues lag by a factor of 16. The same optimism once crowned Cisco and RCA, only for reality to demand patience. As market concentration and circular funding accelerate, risk doesn't vanish, it shifts. In every bubble, capital flows faster than lasting value. The test isn't spotting innovation. It's knowing when the numbers finally need to add up. And in markets, arithmetic always wins, eventually.